Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. In this weekend show, we're going to be talking about some key news releases out of the resource sector and also focusing more broad resource market, trying to get a handle on the correction that we're seeing in some of the resource stocks, the resource prices in general, and just if this is a buying opportunity or how much longer we might need to wait to see a reversal in that recent loss of momentum. Just a reminder, everyone, please go back through our website, podcast, and YouTube channel to listen to all of our daily editorials and company updates. It was another busy week as we still reiterated on some of the key news from this week and brought on a number of companies, a number of them that you have been asking us to bring on. To kick off the show, we are chatting with Matt Geiger, managing partner at MJG Capital. Now, Matt, a lot of people like when we talk stocks, so we're going to start off with some of the news that came out over the last few weeks, starting with Bravo Mining. We chatted about Bravo Mining last segment with you at the tail end of May. They had a discovery hole on May 28th that moved the stock higher. It was a new high-grade IOCG discovery, and, well, quite frankly, it really kind of changed the story for this company. Since then, June 10th, we had a follow-up one assay release. The company has a large drill program underway, still at this T5 area. Now, Matt, since this discovery hole and this one follow-up hole, the stock has broadly moved sideways, which isn't a bad thing considering most stocks have pulled back over that month period. What's your updated comments on Bravo Mining?
Firstly, it's great to be back on the program here, Corey and Chad. Thanks for having me. Always happy to talk Bravo, and I should lead off, as I did in the last call, by mentioning that I'm highly biased on this name. It's our largest holding by quite a large margin. And as one would imagine, I'm following progress there extremely closely. I think this is a good place to start because we did touch on it in our last call. I believe when we last spoke, it was actually on the day of the announcement of the T5 discovery hole, where they hit a stunning 11.5 meters of 14% copper and a really healthy 3 gram per ton gold kicker, which for IOCG style deposits in the Carajás is a very high, exceptionally high gold grade. I think when we spoke, it was intraday and the share price had risen from $2.23 where it opened at to roughly $3 per share when we spoke. And by the time the dust had settled and the market had digested the news, we were up closer to $4 per share by the end of that week. And that's where we largely sit today. Since we've spoken, Bravo did come out with its first set of follow-up results at the T5 target. And as a whole, the results were very positive. The 50-meter step out to the east of the discovery hole hit 8.75 meters at 9.5% copper and 2.1 grams per ton gold. This was an excellent result, as the company had already guided that the width of the step-out hole, or the width of the intercept of the 30-meter step-out, was narrower than the initial discovery hole, but the grades were the key question. And I think the market, based on core photos as well as the company's description, was maybe expecting copper grades, we'll say in the mid-single-digit range. So the fact that we were over 10% copper equivalent in the step-out hole certainly exceeded my expectations and was an excellent result. We also know that the mineralization now extends at least 50 meters to the west of the discovery hole. We didn't get assays for this 50-meter step out to the west. I presume those will be included in the company's next news release. It does seem that the zone is narrowing in that direction, but remains open. So in terms of looking forward to the coming weeks and months, the company's attention has really shifted at T5 to drilling down dip of the discovery hole. And of course, it's open along strike in both directions as mentioned, but I think they'll probably focus on that at a later date. And these upcoming results from the down dip drilling will be hugely consequential in terms of the scale of what they have at T5. We really have two different possibilities here. The first is that they have a small but high-grade deposit, which could be highly lucrative but not valued in the billions of dollars, so to speak. Or in the best case scenario, they have something Salobo-like, which is a close to 2 billion ton deposit, also in the Carajás district, also ISEG style mineralization. That's just an absolute company maker, to say the least. So I would argue that at current share price levels, really either of these outcomes would serve Bravo holders just fine. In terms of a smaller but high grade deposit, it's worth noting that Luis and Simon's previous company, Vanco Minerals, sold their Antis North mine to Oz Minerals. I think this was in 2018 for roughly 400 million Aussie. And this was a relatively small deposit, but because of its location, proximity to surface, a real moneymaker. But ballpark, that was in the range of 5 million tons at 1.5% copper equivalent. So even if Bravo outlines something of this sort, there's very recent precedent of Luis and Simon and most of the rest of the team here, many of which were involved with the Vanco, being able to realize significant value. And in this scenario, Bravo could actually rush T5 into production within a couple years. I know that sounds crazy in the world of mining, where from discovery, it can take 15, 20 years, if ever, to advance a deposit actually into production. But the key here is that Luanga already has been designated strategic minerals project status from the Brazil government. So the project has already been distinguished with this, which leads to much shorter and streamlined permitting timelines. So I think that's a very key point here in the case that this is a smaller but high-grade deposit that's of the size of something that Bravo could realistically develop. Well, less likely at this stage, I think the grand slam potential here is a Salobo-like outcome, which would take the size of the prize into the billions of dollars, unquestionably. Salobo, again, as mentioned, is in the Carajás district, not too far from Luanga, and it's characterized by numerous high-grade pockets of mineralization within a much broader zone of low to medium-grade mineralization. And if we start seeing intercepts at T5, broad intercepts of, say, 0.5% copper, I think this would actually get the market more excited than if we were to see additional very high-grade 10-meter intercepts that we've seen to date, because this speaks to the potential scale of the system. So both of these possibilities remain on the table, and we'll get further information here soon as these step-out holes down dip from the discovery hole are completed. And as you mentioned, it's still very early days here. There'll be plenty more to talk about in coming weeks and months, and Bravo, of course, is very well cashed up with a cash position at 29 million US as last reported. So they can go 12, 18 months easy, even at a increased pace of exploration before they have to access capital. And then they've also seen some love at their T16 target, which we can save for another discussion. But they're intersecting narrow and high-grade copper in a style of mineralization that's not been observed previously at Luanga. So I don't think this says that they've intersected the feeder zone per se, but they may be getting warmer. So I know behind the scenes at the company, there's a lot of excitement about that, even though the market at the moment is razor focused on what's going on at T5.
Well, Matt, just a quick follow-up on it. As someone that's been following the stock for a long time like you have, they were initially known at Luanga for the PGMs, the platinum and palladium and the nickel. And so when a discovery like this is made, where a big copper discovery, possibly copper gold, is underway, whether it's the high-grade, smaller deposit scenario or the larger district scale scenario, either one sounds like it's going to be a good option. But how does somebody that's an investor really track? Do you think this is bringing in different types of investor that were in Bravo before? Or do you think that they now have to kind of ignore the nickel and the PGM side of things to focus on the copper because that's where the action is? It's always interesting when a company makes a new discovery when they already have a big deposit defined. So just curious on your outlook and how you think investors are positioning now.
And it's fascinating, right? I mean, strategically, and it's a difficult situation for Luis and the management team because there's really three different things going on here. They have the existing deposit, which they're drilling out and pushing forward towards production with a pre-feas expected in the latter half of 2025. So they're doing plenty of infill drilling there, as well as extensive metallurgy, which they've really been doing since day one, which I think differentiates themselves from many juniors out there who in some cases would prefer not to know the metallurgy of their specific project. They're also, of course, pushing forward T5, which is a significant discovery. Scale is still a question, but significant nonetheless. And it's added 200 odd million to Bravo's market cap in just the 4 weeks since it was announced. So that obviously needs to be a focus of theirs, is a focus of theirs, and has attracted a huge number of new eyes to the story who are maybe less interested in a PGM and nickel development play, but love the concept of a high-grade copper deposit or discovery right in the middle of the Carajás. And then the third focus would be exploration more broadly across the land package. I mean, they outlined 17 high-priority EM targets. They whittled that down to 11. T5 was either the first or the second of these that they tested, and boom, major discovery on their hands. So they're not going to give up on the broader exploration thesis either. And Luis and the team have actually guided to the market that they're going to increase their regional exploration and go ahead and test all 17 of these regional targets by the end of this year. So they have three things going on at once. I guess the lucky thing from Bravo's perspective is they have a very healthy working capital position relative to your average junior. So if they're more capital constrained, they'd have to make some tough decisions on which of these three baskets in which to put their eggs. But at the moment, they're going with an all of the above strategy. Of course, if T5 continues to grow and maybe starts to look something more soluble, we may see resources pulled from elsewhere on the project and focus there. But I think at the time being, they're comfortable advancing each of these three work streams in tandem.
All right. Well, a story that we'll definitely be following up on because there's going to be a lot of drilling news out of there. Again, we've just had one follow-up hole. Company, as you said, has a lot of money. Still a big drill program ongoing. It'll be interesting to see how the market reacts to future news. Let's move on to another news release from just this week. Skina Resources announced a $750 million U.S. finance package for the Eskay Creek project. That was with Orion Resource Partners. Now, this is a lot more money than the number that was in the definitive feasibility study of pre-production capital expenditures being a little over $525 million U.S. Matt, what was your takeaway from one of the largest financing packages we have seen recently in the resource sector?
It was. And I mean, my first thought is I remain ever impressed with Orion. They're really the only full-service mining finance group out there that can offer varied financing package of this kind. And I think this deal includes an equity investment, a gold stream, some senior secured debt, as well as a cost overrun facility. And usually with this type of billion-dollar financing package, you're talking about herding cats and bringing together 3 to 4 different parties in a complex negotiation. And those can be very difficult to get across the finish line. So I think Orion continues to distinguish itself as a group where it's kind of a one-shot stop if they like the project. Second takeaway, it's been interesting to see a bit of a sell-off on the back of this news. I think Skina shares initially reacted well in yesterday's trading, but from their intraday high on Tuesday, and we're talking midday Wednesday here, they're down 12 or 13% from that intraday high. So only the sellers really know exactly why they are selling. I guess there's a couple hunches that I would have. One is perhaps, as you mentioned, Corey, there's some folks that were scared away by the size of the package relative to the initial CapEx that was guided by Skina in their feasibility study. And I think there's also probably a contingent of investors that are concerned, or at least have the perception, that Skina has now committed to go it alone and build Eskay Creek themselves. So it's likely a good contingent of Skina shareholders are those that are betting on an M&A outcome here, seeing an advanced mine, not fully permitted to build yet, but presumably getting close, and are looking for a larger party to come in and take out Skina at a premium to the current share price, rather than Skina to go it alone and build Eskay Creek. Because look, I mean, it's highly risky for a single asset group to execute on a mine build, and there's just very little margin for error. Of course, on the flip side, it can also be highly lucrative for those groups that attempt the endeavor and then are able to stick the landing. So my hunch is that the sellers yesterday and today is probably a combination of surprised by the size of the package and or are taking this to mean that Skina is going to go it alone. But we're talking pre-show that there's no break fee on this transaction. So I think that's an important point to emphasize, that Skina is not committed to building this as of yet. They clearly are a step closer to doing so. But if a larger party were to come in, either in the subsequent weeks or, post receipt of final permit, they're not locked in to pushing this forward. So I think that's an important takeaway. It's maybe lost on some of the sellers over the past couple of days.
Yeah, Matt, I think that's a great point. And then also, when we've looked at historically when takeovers have happened, there's a lot of companies that have signaled to the market that they were going to build a mine, only to have that mine scooped up from them by a larger producer saying, hey, before you go ahead and get all the way through this, let us take over. So that's still an option on the table that I think maybe some of the sellers in Skina haven't considered, is that they still are an M&A candidate. They still need to get that environmental permit. That's one of the last hurdles to cross. But in your experience, Matt, when you look at something like a G Mining, where they take it all the way to production at Tokenizio, that's one option for a company.
Sure.
But do you think that a lot of companies that are at the development stage right now have to do what Skina just did and signal to the market that they're going to build it? Because if not, they're just sitting there waiting with their hand out to be taken over. So is this the right tack to take, to put together the financing, to show the market the financing package is there, the capital stack, and start moving it forward? Because you're far more likely to get on the radar of a major at that point than you are if you're just waiting and don't have the financing package together.
Yeah, I think that's right. I mean, only Skina management knows which direction they're ultimately going to go here. And perhaps it's still an open question within the boardroom. But in terms of increasing leverage in negotiations and competitive pressure, I mean, any company, even those that are desperate to sell, if management's worth their salt, they're at least going to bluff that they have the ability to build the mine themselves. And that can be done by either arranging a financing package, such as what we've seen just here, or hiring the personnel that could presumably go ahead and build the mine. Because it's very rare to have the same group of people that may be experts in developing a mine and pushing it through a feasibility study. The skill set of actually building the damn thing on budget and on time, it's a totally different ballgame. It takes a whole different set of personnel. So there's very few groups out there that have the expertise that are able to do both. So look, even if Skina's view is that they ultimately want to sell this step would make sense. And I guess if they wanted to further indicate to the market that they're willing to go it alone, they could also bring some folks on board in the coming weeks and months that have that mine build experience. And that only increases the credibility of their claims that they're going to go ahead with this.
Hey, just nice to see and very interesting to see a big financing package done. There are a lot of companies out there that would love to get this kind of financing package to move their asset forward. Unfortunately, a lot of these companies are still kind of stuck at that whole financing stage. And if anyone listening wants more information and some insights from management, I interviewed Walter Coles, the executive chairman of Skina Resources, on Wednesday. That was posted on Wednesday, so have a listen to that interview. Now, Matt, kind of a negative story out of the resource sector was Victoria Gold announcing a heap leach failure. The stock just got crushed on it. The stocks in the area, in the Yukon, in that Tombstone Gold Belt also got hit on the back of it. Not nearly as bad as Victoria Gold, but now there are some huge questions around what's going to happen with Victoria Gold and that mine. Right now, it is on hold. It's paused. We're all waiting clarity. What was your takeaway and initial reaction to that Victoria Gold news?
Yeah, it's a real shame for the whole industry. I mean, this is the second major heap leach incident that we've had this year, the first being SSR Mining's Tripler project in Turkey. And it's a real black eye. I mean, I guess my first thought when I saw the news is that I'm relieved that nobody was injured in the incident. Obviously, in the Tripler incident, that was not the case. So I'm happy that there was no harm done to individuals either working at the project or visiting. Believe it or not, participants in this year's Yukon Mining Alliance Tour, which I was fortunate enough to do back in 2019 myself, were literally on site the day before the incident took place. So I'm just very happy that everybody there is safe and sound. And look, I mean, I also feel terribly about the 500 jobs. This was a major employer in this Mayo region. They look very much at risk as a result of this failure. And I mean, the MJG partnership has never been shareholders of Victoria, but I did visit Eagle in the fall of 2019, shortly after their first gold pour. And there's some wonderful people working there. Look, I mean, there's still lots of unknowns about the incident itself. A few that come to mind is, how did it happen? Why did the stock not get halted immediately? It seemed to trade for a few hours post-incident, which struck me as strange. What are the resulting liabilities, and environmental or otherwise? How much will it cost to repair the conveyor and any other equipment that was taken out in the spill, let alone rehabilitate the pad, or will the pad have to be entirely relocated in a future production scenario? How long will this all take? I mean, there's really more questions than answers at this point. And I do expect there to be plenty of postmortems in the months ahead by multiple regulatory agencies, both provincial and federal. So we'll get more answers, but it might take some time to come out. I mean, going forward for the company and its equity holders, they're in an incredibly tough spot. The Victoria balance sheet was already stretched pre-incident, and it has a 6% royalty encumbrance as well, between royalties held by Osisko Gold Royalties and Franco. So there's no, get out of jail free card there in terms of selling a healthy royalty to raise the capital necessary to clean things up and get the production back into operation. I really don't see a white knight swooping in here and buying the company, at least anytime soon, especially with all the unknowns that I just mentioned, most pressing being the environmental liabilities and the extent of those. I also think it's unlikely that we'll see the lenders in this case. It's a syndicate of lenders, Bank of Montreal, CIBC, National Bank, and Desjardins. I don't see them pushing Victoria into bankruptcy, as they won't want to own this asset, nor do they have the capacity to own this asset. So I guess from an equity standpoint, that's good news. I would argue at this point, the most likely outcome is probably a Gold Mountain mining type scenario, where the company is largely kept on life support, but not going bankrupt, but resulting in extreme dilution to the company in the process. And I guess it's also possible that further down the line, we could see this lending syndicate sell their debt, very likely for pennies on the dollars, to a vulture, whether that's a mining fund or another mining company remains to be seen. But a vulture who actually wants to take ownership of the asset, do the necessary work to clean things up and get the project back in good standing and then put it back into production. But, either way, there's really no quick fixes here that I see. And I don't see this being resolved anytime soon, which is, really unfortunate, again, going back to the workers involved.
Well, Matt, just to follow up on, I guess, the contagion effect in the Yukon area, because we did see a lot of those stocks get hit pretty hard yesterday in sympathy. Now, some of them have clawed their way back today, but a lot of people looked at Banyan, for example, as the natural suitor being Victoria Gold. And does this interrupt that process now? What does this mean for Banyan? Do they have to find a standalone operation now? Snowline Gold has to get their project built eventually in the Yukon. If there's an environmental contagion, because they're saying that there's possibly a cyanide leak from the heap leach pad into the water supply, into the water table, could that block permitting for a while in the Yukon? Sitka Gold just bought a property from Victoria Gold, and it made sense for their land package, but now that's one less property that Victoria Gold has that they could switch to. So what does this mean for the larger Yukon area, do you think?
Yeah, it's not great. I mean, the Yukon this is not Alberta, this is not Saskatchewan. Mining was already under, and it has been under for many decades, under a pretty close microscope. Of course, it's a shame. I visited Armac twice. That's Banyan's project, not far from Victoria. And it's really a double, some could say a triple whammy there. And in that one of the obvious potential acquirers is now not going to be in a position to do so. Banyan's also looking at a heap leach operation. So this incident does not help permitting on that front. And then, of course, just the close proximity. We'll have to see how residents and government and the Mayo community react to this and whether it could put a pause on development for the time being. I mean, that's an unanswered question at this point. Look, I mean, Snowline, Yukon is massive. It's hard to get a sense of the scale until you're actually up there. And they're on the complete other side of the province. They're also not looking at a heap leach operation. So one could make the argument that this shouldn't have any effect on them. But by the same token, it certainly doesn't help. And it can affect perception. And of course, Snowline's still pretty early in its growth trajectory here and aren't even getting close to having to worry about permitting at this stage. So I think they're somewhat insulated from that perspective. But we'll just have to see how things shake out for the Yukon more generally. This definitely, even years down the line, could dampen interest in larger groups coming into the Yukon, which would be a shame for all parties involved here.
Yeah, it really would be, because the Yukon, that Tombstone Gold Belt, it was one of the standout areas over more than just the last few months in this market rebound. Who knows what's going to happen there, but definitely a negative story from this week. Matt, general market comments regarding resource stocks. It was a good run that they had from late February or early March up through either early to late May. And then we've seen a little cooling off, a little bit of momentum loss. The mid-tiers, the majors, they're still generally holding up better, but the exploration plays, man, a lot of those are almost right back to those March lows. Some are even lower than that, ones that didn't get much of a bounce. How are you viewing this market right now where it was a nice run for about 3 months? Now we've had a month of cooling off, and it just seems like a lot of interest and even a lot of good news is being sold into.
Yeah, I sense a lot of frustration out there, particularly amongst junior investors, but even mining investors more generally. I mean, gold has had a very significant price breakout here thus far in 2024. And just judging by the GDX or GDXJ, they've presented no leverage to this move in gold. They're either roughly equal to gold's move or slightly below, depending on the indice that you look at. But by and large, whether they're the big boys or the producers, all the way down to the juniors, they're either barely keeping track with metal prices or failing to do so. I mean, I'm just in the midst of writing the most recent MJG investor letter and went back and kind of evaluated our holdings performance so far this year. We're fortunate to have had 4 positions increase by over 50% year to date. So those have very much carried the portfolio. But if I look at the rest of the portfolio, there's nearly as many names that are down on the year, despite the positive metal price action that we've seen, as those that are up. So this is far from a rising tide lifts all boats scenario. And I think there's some frustration or exasperation out there. Look, if you asked me a few weeks ago, I would have said that we're potentially setting up for a 2016 or 2020-like summer, where things get very euphoric in the junior space. But I would say now that's looking far less likely to be the case. Perhaps the increase in Canadian capital gains taxes for wealthy individuals has played some part in this, at least in kind of dampening some of the excitement that you mentioned we began to see in late April and into the third week of May. With that said, I'm not advocating the sell in May, go away strategy by any means here either. We've seen significant moves in both gold and copper. Those are real, and I think augur very well for what's to come in the following years. And there is going to be a point here where we do see that euphoria in the junior space, and it's hard to predict when. And it's important for investors not to try to time that perfectly, but ensure that they have exposure to high quality names that are doing good work and aren't in risk of imminent share dilution for when that comes for them to have exposure, because things can happen very fast in this space, as we know. And look, I know this will be cold comfort for many of the listeners that have junior mining exposure at the moment, but I could really make a strong argument that the fact that we haven't seen euphoric price activity on the back of the gold and copper price breakouts actually augurs well for the duration and the breadth of the move that we're likely to see to come. So I would urge folks to have patience, but look, I'm sympathetic to the frustration that's out there, as year to date, mining stocks generally, and particularly the juniors, have entirely failed to provide any leverage to the price breakouts that we've seen among some of these bellwether metals.
Yeah, very good points, Matt. All around, thank you very much for taking time with us. I will post a link to the MJG Capital website in the show notes for this weekend show. Always interesting to hear what you're seeing in these markets. And look, there have been some standout stocks, a bit more than in a true bear market, but you are right. There just hasn't been that major leverage that a lot of these investors are waiting for. Maybe it is just around the corner. It's, again, that wait and see type of mentality. Matt, thank you as always for your time. It's a pleasure chatting with you. Everyone, stick around. We are going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and we are going to continue to discuss more of the commodities markets, more of a focus on precious metals as well as a mix of maybe some base metals, energy in that whole narrative. We are now chatting with Jeff Christian, managing partner at the CPM Group. Now, Jeff, earlier this week, you held a webinar, more of a Q&A with your clients, with the people that wanted to tune in, where you were simply answering the questions that they have sent in. We're going to use one question that I know is on a lot of precious metals bugs' mind to start off here, and that is the relationship between a potential recession, especially in the U.S., and gold and silver prices. Jeff, take us through your thought process here of how gold and silver prices react to a potential recession, whenever that might be.
It's interesting because I think the one that the historical precedent to pay attention to is the recession, double dip recession from 1980 to 1982. And that was a recession in which you saw the gold and silver prices, along with copper and oil and a variety of other commodities. The gold and silver prices rose very sharply in the year prior to the recession. And if you look at where we are right now, economic data is suggesting that the economic growth that we've seen 2021, 2023 is slowing down. There are signs that we could be slouching toward a recession, and you're seeing increased signs that could happen. And the gold and silver prices and copper prices have risen very sharply over the last couple of years. So that's one of the things. You do have times when you see a recession and the gold and silver prices rise during the recession. And you also see times, for example, in the Great Recession, where gold and silver prices, gold started rising in 2002, silver started rising in 2005. We didn't get into a recession until the fourth quarter of 2007. The recession was over by 2009, but gold prices and silver prices continued to rise before the recession, through the recession, and then in the 2 years after the recession. And they both peaked in 2011. And that reflected the fact that not only did you have a recession, you had the global financial crisis going on. You had the sovereign debt crisis in Europe, focused on Greece, but really throughout the southern tier of the EU zone, the Eurozone. And you had the downgrading of the U.S. Treasury equity debt in August of 2011. So the conclusion you need to draw is that we always say, people say, what's going to cause the next recession? And the answer is a variety of things coming together at the same time. There's usually not one thing that causes a recession. And in order to understand what the recession is going to look like and what it's going to mean for gold and silver, you have to look at the myriad of causes for that recession. And similar to where we were in the period 2005 to 2011, you have a lot of other factors that could contribute to a recession late 2024, 2025, that could continue beyond the recovery from that recession. And throughout that period of time, you could see investors continuing to buy outsized amounts of gold and silver, driving the prices further higher. So our expectation is that slouching toward a recession now, that's positive for gold and silver. Getting into the recession probably will be continuing to see investment demand and prices rise, and even coming out of the recession, because some of the political and economic and financial market problems that will contribute to the onset of the next recession will survive the recovery from the recession and continue to plague the world in a way that drives investors to buy more gold and silver, keeping the prices high and rising.
Well, Jeff, I'd like to tie in copper into the discussion here and really dial into both silver and copper, because they both had breakout moves in May, where silver finally broke above 30, where copper broke to new all-time highs. And some of that was based around the energy transition narrative, and that there's going to be a lot more energy capacity needed, so more copper to transmit it, more silver for solar panels. But then they both rolled over very hard over the last month. Is that in relation to the concerns about slowing of the economy, or how do you square those two narratives, the energy transition narrative and the economic contraction narrative with silver and copper?
I think that what you're seeing in both copper and silver have done very well up until late May. And they were, as you said, there were two sets of factors that were driving investors to buy these two metals. One was the idea that we needed more copper and silver, that the world was short of this stuff, and we had a stronger economy than people had thought. We had certain supply disruptions in the copper mining industry on a global basis. So there was this shorter-term economic fundamental tightness that was driving investors to buy copper and silver. But there was also the energy transition. And I think one of the things that you've seen over the last 6 weeks or 8 weeks is that, people have started to pivot their concerns away from, we're having a soft landing, we won't have a recession, to, we could get into a recession, and that could really reduce fabrication demand for copper and to a lesser extent for silver. And there's also been growing skepticism about the pace of the energy transition going forward. And there's concern that a Trump victory, if the Senate flips to the Republicans, that you could see some of the energy transition legislation revoked or negated, and you could see a lot of money being pulled out of some of these programs, federal money, which then would cause losses for the private money that's gone into investing in energy transition technologies. We saw a poll recently, actually we saw the results today, that said that half of the Americans who have bought electric vehicles say the next vehicle they buy will be a gas-powered vehicle. So there's some growing realization that the energy transition to electric vehicles will not be as fast or as large as had been anticipated by copper investors, and that there's also some headwinds in the solar power industry. Not so much that the technology doesn't work, but that there are constraints for componentry, and there are some capital constraints. Solar power is still growing, and it's growing rapidly, but it can't grow as fast as the world would like to see it grow because of a variety of these constraints. And so I think that you're seeing some investors sort of get, maybe we were overly enthusiastic about copper and silver prior to May, and maybe we need to take a more sober reexamination of how much copper and silver the world really will be needing over the next 1 year, 3 years, and 25 years.
So the fact of the matter, Jeff, on the more demand side is that energy needs do continue to grow, whether we satisfy that with green energy solutions or old school energy. It's going to be a mix. I think everyone agrees with that. However, some of these cleaner energies have been on upward growth trends. How do you see this mix playing out if certain things like solar can't keep up to the sky-high projections that some people have? What's the mix that you see in terms of metals and other energy sources that will be used?
We key our energy mix projections. We take them out to 2050. So we're going out 27 years, 26 years right now. And we key off of the International Energy Agency, their long-term projections. Our expectation is that by the year 2050, the major source of energy for humankind will still be oil. Now, oil demand may have plateaued for a couple decades by then, but it will still be the major place where we get energy. Natural gas will be the big winner. It has been over the last decade, and that will probably continue. And by 2050, we think that natural gas will be close to petroleum in terms of its contribution to the global energy supply. Solar will continue to grow, but it will remain a relatively smaller source of energy. The IEA and CPM Group expect that by 2050, all renewable energy will be the third largest source of power, and that of that, hydropower and solar will be the two biggest winners. Wind power has more headwinds than solar power and hydropower. And then nuclear, which is very interesting, is going to grow very little over the next 25 years. There's some great new nuclear technologies. There's renewed interest in understanding it as a clean energy source or a relatively clean energy source. But there are massive social and political headwinds and opposition to building new nuclear power plants. And that's going to take some time to overcome.
Well, Jeff, when we get just back into looking at all of these different metals type, another thing that comes into the discussion is how much can be recycled of each one. And so looking at scrap supplies of silver and gold, looking at how much copper could come to the market, what's your impression on how recycling or people trading in metals at different prices are going to affect the markets in the year to come?
Yeah, copper and silver recycling, which has been primarily jewelry and silverware and silver, but increasingly electronics because of increased electronics demand, and also regulations that require end-of-life electronic goods to be turned in for recycling. Recycling of end-of-life materials has represented 15 to 20% of copper supply for decades, and it's growing. And it also has represented about 20% of silver supply, maybe a little bit more than that, maybe closer to 25% or 30% of silver supplies. And it's probably going to continue to grow. You're already seeing recyclers reprocessing and recovering silver from end-of-life solar panels and from mismanufactured solar panels. So that's already coming along. So in terms of those two metals, we expect recycling to continue to grow, partly because the world is becoming more oriented and recycling positive than it used to be, and partly because there is this growing body of recyclable copper and recyclable silver that's out there. As I said, traditionally, most of the recycled silver comes from jewelry and silverware. That's a price-sensitive consumer decision. People who own silver or silverware or silver jewelry, and say you get into a recession and financial constraints are there and the price of silver has shot up, you sell some of your old silver jewelry or silverware and to raise cash. That's changed somewhat, and the mix of silver scrap has changed, as I said earlier, to more electronics and industrial material. Electronics and industrial materials for copper and for silver are not so much cyclical or price sensitive. The industries that use this stuff and recycle it invest in a recycling equipment and system. They develop the ability to gather this material and recover the reusable metals. And having made that investment, they'll continue to do that even if the copper price falls and even if it's not as attractive as it would be for silver, for consumers to sell their silver jewelry. So we think that you'll see a more sustainable, you already are over the last 5 years, seeing a more sustainable flow of copper and silver from secondary materials. And that's going to continue.
What about looking internationally too, Jeff? How much weight do we need to put on what China's doing? What metals even China controls in terms of an energy transition or general energy needs, and other up-and-coming countries that will also need a mix of energy to supply what their growth plans are?
Yeah, that's a real issue, and it's an issue that it's a political solution, and the United States government has, over the last 4 administrations, taken a more hostile approach toward China. So too has Europe. So too have Eastern and Southeast Asian nations that are close to China and Australia. So you've got a breakdown of international cooperation with China, and that is bifurcating the economy, and it's also bifurcating the markets for these metals. And that's a real problem. And the solution needs to be political. And right now, what a lot of countries are doing is saying, rather than learn to live with communist Chinese government in a cooperative fashion, the way we tried in the period from, say, the 1970s until 2006. Rather than do that, we're going to try to build our own specialty metals industries and processing industries. And there are severe negative limitations to what you can do and what you can accomplish, and it'll be very costly. It'd be much less costly and more economically efficient to learn to live with other countries, but that doesn't seem to be on the cards right now.
Well, Jeff, I appreciate you breaking down the global look, and yeah, it is a complicated web, but we definitely need to get your thoughts on where you think the pricing is going in gold, silver, and copper. You know how it is, Jeff. People want to know where are the metals prices going, and you've got a pretty good handle on not just the supply-demand fundamentals, but also investment demand and how that factors in. So I'd love to get your thoughts on that.
Yeah. Our view on gold is that prices traded mostly between 2,300 and 2,400 since really the beginning of April, the first half of April. Couple spikes over 2,400. Our expectation is the price basically trades between 23 and 2,400 for the next 2 months, July and August. Once we get into September, October, we think that political and economic factors could take the price over 2,400 and possibly over 2,450. So we're looking for higher gold prices beyond August. Silver, we've got a similar but maybe slightly more pessimistic view. You know, silver was trading in this range of, say, 30 to 32 in the second half of May. It's come down, and it's really been trading between, say, 28 and 31 since that time over the course of June. Our expectation is that there is some vulnerability that the silver price could come down to $28 or maybe even go below $28 over the next couple months, but then we expect it to recover in the final 4 months of this year and probably move back over $30 and possibly even over $32 over the course of the last 4 months of this year into 2025. Copper, right now we're expecting it to sort of move sideways next year at relatively high prices and possibly move higher in 2025. If we do see a recession in late 24, early 25, during the recovery phase, we think that copper will be in a tighter market balance and you will see higher prices, but probably not until really, 2025.
Jeff, one other aspect of the investment demand that I want to get your thoughts on are deal with fund and ETF flows. Clearly on the fund side of things, we're not seeing really any inflows into current metals funds or even new metals funds entering the sector. That impacts the underlying equities. But even in terms of ETFs, we're just not seeing those sort of flows. What's some of your data shown you in terms of the bigger money, whether it be specific funds focused on these metal sectors or just even the ETFs fund flow wise?
I think it's two distinct things. I think with the funds, what you're seeing, these are equity funds that you're talking about, right? And I think with that, you continue to see investor disenchantment with mining. And that's being reflected in a lack of investment in equity funds, mining equity funds. With the ETFs, the physical metal ETFs, you've seen net sales of gold ETFs for 3.5 years now. And our take is that is a counterparty risk move because you've seen strong demand for physical gold on the part of investors worldwide. But as they're buying more higher volumes of gold bullion and coins, they're also selling off their gold ETFs. So I think what you're seeing is both institutional investors, high net worth individuals, and retail investors saying, I want to own gold directly. I don't want to own it through an ETF, partly because I want to have access to physical gold should I want that. But more importantly, I don't want the counterparty risks with the various financial institutions that operate and manage those metal ETFs.
Jeff, what about some of these new ETFs that especially Sprott has come out with, focused in copper, uranium funds? They've come out with a couple of those as well. We're seeing some new ETFs, again, in these sectors, focused a little bit more on the equities. They're generally small right now, but is this a good trend for the sector?
I think it's a bad trend, ultimately. Back when molybdenum prices rose very sharply in the mid-aughties, you saw a molybdenum fund created, and the investors ultimately lost $300 million in it. And you've seen cobalt funds that focus on relatively small, illiquid, single metal markets. They're like traps, because when the price is rising, investors pour in. And a lot of these funds, and some of them are closed-end funds, which have additional problems, but a lot of these funds, most of these funds, the managers have no discretion on timing. Money's coming in, they have to buy assets. Money's coming out, they have to sell assets. And everyone knows that, so that while the price is rising, there's not enough moly, there's not enough copper, there's not enough cobalt, there's no direct ownership of uranium, or there is direct ownership, but you can't hold it because of its uranium. So you run out of physical metal and you start buying stocks. And all of a sudden, you have your maximum amount of most of the companies that are exploring for these metals. Copper's a little bit different because it is a very large metal market, but these smaller markets are really problematic. Then when the price of the metal peaks and starts coming down, the fund manager has to sell. And every day his decision is, what do I sell now? And everybody else in the market says, that fund, which reports daily its assets under management, is a seller. We know that the asset value of all of these things that it owns will come down. And so what I think that these single metal funds do is they exacerbate the upward move during the bull market, and they exacerbate the downward move. So from a market perspective, they're not good. And from an individual investor who's investing in them, they're not good. So we're not big fans of those funds. I mean, gold and silver are unique. When the gold ETFs were created in the early aughties, the SEC said, okay, this is gold. The real test for commodity ETFs will be silver, because silver is much more of a commodity, gold's more of a financial asset. And so when the silver ETFs came out, 2006, 2007, that was the big test. But then again, silver is a quasi-financial asset. You have billions of ounces of silver in above ground refined inventories to meet that supply and demand for the ETFs. You don't have that in copper or lead or zinc or aluminum or manganese, other things. These industrial metals measure their inventories in weeks of supply, whereas gold and silver measure their above ground inventories in years of supply. So it's a radically different market balance that is skewed against not even single fund ETFs. You can have an LME ETF, but the availability of inventories to cover that and to provide the necessary liquidity simply not there.
All right, Jeff, thank you, as always, for your time. I always find it interesting to hear the questions you're getting from some of your clients and the companies you work with, as well as what you're seeing on the investment front for a lot of these commodities. I know a lot of our listeners still wondering just how much longer this correction is going to go on for and when that next leg up will be, not just for the commodities, but when money will truly filter into some of these stocks, and we'll see a broad outperformance of the stocks over these metals prices. Everyone, thanks for keeping in touch with us throughout the week and on the weekend. Please keep emailing us, and please keep tuning in to our website, podcast, and YouTube channel for all the daily editorials and company updates. Jeff, again, thank you for your time. I hope you have a great rest of your weekend. And everybody, I hope you all have a great rest of your weekend. Everyone in Canada, I hope you have a great Canada Day long weekend. Thanks for tuning in this weekend, everyone.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.